Hi everyone, welcome to today's webinar with me, Fawad Razaqzada, and my colleague Victor.
Hello.
Hi Victor, how are you, mate?
Very good, very good. How are you, Fawad?
Yeah, very, very good as well. Thank you so much for asking.
Right.
Today is Wednesday, so we're doing this webinar a day later than usual. We had some technical difficulties yesterday, but from next week onwards, usual services shall resume. So the next webinar will be on Tuesday of next week. We have a few more until the end of the year, and then we're gonna pause it in the Christmas, in the week between Christmas and New Year's, and then normal
That's
services
a
will
dull
resume.
week. Always
Yeah,
the markets are not moving, so we're
exactly.
gonna take some time off as well.
Yeah. And then from 4th of Jan, things are gonna resume as normal. Anyway, we'll share the details later on. Before we begin, these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, what are we looking at then, Victor?
Well, I would say that we're stuck between a rock and a hard place, between monetary policy and COVID headlines.
Indeed.
That are coming in super unexpectedly every day, and it's it's not like you get scheduled news, then you can wait for the news, but this is different. And yesterday we had a blow-off rally that basically squeezed out most of the short positions out of the market. If there are any remaining, we'll see. But that rally was primarily driven by some information that the Omicron variant might be not as bad as initially thought. But then this morning we got some news that it largely evades Pfizer's vaccine.
Oh, right, really?
There is like it doesn't evade it fully,
right?
But the vaccine provides only partial protection, which makes one wonder, since it has already been partial, since we have people who get sick despite being vaccinated. So more partial than before, I guess, is the answer. So
and we heard something from the UK as well. There reports circulating the media, the social media platforms, that the UK government is going to introduce Plan B.
What is Plan B, Fawad? Tell us, for those of us who don't live in the UK.
Yeah, Plan B is basically not Plan A. It's basically, obviously, the government wants to keep everything open and don't introduce any lockdowns if everything is going according to plan. However, if things like the new variants come out, like which we have seen in the case of Omicron, then the UK government has previously said that they have a Plan B in place, which is to reintroduce some of the lockdowns in the stages to stem any spread of the new variant or whatever variant that's prevailing at that time, to help the UK kind of weather the storm. So right now, obviously, we have a new variant of COVID, and the existing variant, Delta, has been spreading rapidly across Europe, and cases in the UK are rising as well. So there are reports that the government today will introduce like tighter restrictions, so-called Plan B, in response to these to the surge in infection rates. And that news has really weighed on the pound this morning. You can see the cable slipped from around 132.50 at the open to a low so
Yeah.
far of 131.
It also
80-ish.
affected risk in general. I
Yeah,
saw that oil prices have dropped materially.
yeah,
Well, not materially, but yeah, dollar and a half after the news came
yeah.
out.
Everything. So you can see crude oil here. Brent crude oil has come off its highs from yesterday.
Yeah, it was
You look at
trading
the
around. I'm not so familiar with the Brent price. More, yeah,
WTI. Yeah, it's
yeah,
trading
it
at
was
around
trading around
71. Yeah,
72.50, and it dropped a dollar and a half after
yeah,
these headlines circulated
yeah,
across the news wires. So yeah, we should be. I mean, the cautiousness should prevail,
yeah,
and unexpected, pretty random market moves
yeah,
are the theme that has been happening since the beginning of this. Well, since
yeah,
the end of last month. I mean, since we got that new variant, things have been rather chaotic. Very minor headlines have triggered huge moves,
yeah,
and the market is just squeezing the weakest positions out of the market, and
yeah.
that's what it does best.
Overall, I reckon that the markets may have reached a low. I don't know. I mean, this is what I'm feeling. We had several days of consolidation below the 200-day, for example, on the German DAX index. And then yesterday we decided to break out. So for as long as we hold the breakout above the 200-day moving average on the DAX now, I reckon the path of least resistance is back to the upside, at least for some indices. Certainly for European indices, I reckon, because of the ongoing support that's been provided by the European Central Bank. That's not to say that I'm expecting a massive rally. I think we're going to see some consolidation here and then possibly renewed strength coming in as we head towards Christmas and end of the year. One particular index that's caught my attention is the South African index. I know most people probably don't trade this, but remember the Omicron variant was kind of first found in South Africa or the countries around South
Yeah,
Africa. And had it been a major concern for the market, surely the South Africa 40 index will not
yeah,
be trading at record highs. So the fact that it is, we broke out yesterday cleanly above the consolidation high. Um,
yeah.
this kind of points to risk on environment to me rather than risk
And
off.
then today also
Yeah,
we got some headlines that hospitalization rates in South Africa are rising,
yeah,
and for now we have a pullback. How long
yeah,
is it gonna last? Nobody knows.
yeah. Previously, the reports out of South Africa were that although hospitalization rates have been rising, these have mainly been for people who are not vaccinated or have only had one jab rather than being fully vaccinated. And also, severe cases have been low and deaths as well. So the market is not too worried about the new variant as it was, for example, a couple of weeks ago when everything sold off. But if you look across the board, I mean, look at S&P 500, for example, massive rally, massive. It's kind of made back all the losses that it had suffered previously, and we're back to square one.
We're still
Likewise,
waiting, by the way, to
yeah,
hear from the major vaccine makers,
yeah, yeah,
BioNTech and
yeah,
BioNTech, which is Pfizer's partner,
yeah,
and Moderna are expected to make announcements with some official data how their vaccines are doing against the new variant.
yeah,
I expect to hear from BioNTech today or tomorrow, actually.
Yeah. So this is going to dominate the headlines for the next few days and dictate market direction. It's not going to be very much insofar as macro, data, but more about the efficacy of the vaccines and how strong or otherwise this new variant of COVID is going to be. That's going to dominate the market agenda for the next few days, possibly weeks. But judging by how the market has behaved, it looks like investors have made up their minds that this latest version of variant of COVID is not as deadly or as whatever as previously people thought.
As bad as feared.
As bad as fear, that's the word I'm looking for.
Yeah.
For otherwise, the market will not have risen back as much as they have. Maybe the market is getting it wrong. Who knows? But for now, the key point being is that in the eyes of the market, this new variant is not as bad as previously feared. So the path of least resistance is clearly to the upside for major indices. I wonder though if this will last very long, because we have a flurry of central bank meetings coming up next week. Let me just get rid of this and show you. So obviously this week, before we move on to next week, we have ECB's Lagarde. She spoke early this morning. But we got the Bank of Canada rate decision. We had the RBA on Tuesday. Next week, before we move on to next week, we have US CPI as the main data release this week on Friday. But look what's happening next week. We have a number of central bank meetings coming up, not least the Federal Reserve on Wednesday. So we'll have the updated economic projections or the dot plots from the FOMC. We'll have also the Swiss National Bank. Remember, the Swiss currency has been strengthening a lot in recent times, but so far we haven't seen any intervention from the SNB. We have the Bank of England rate. This is going to be very important, the Bank of England decision, because previously people were expecting a moderate rate hike from the Bank of England to the tune of 0.15%, I think. But those expectations have been kind of slashed and dashed, indeed. Now the market is more like 45 to 55 in the favor of a no hike, given the risks surrounding the new variant of COVID. Yeah. So the market thinks that the Bank of England will hold off hiking rates at this particular meeting. And that's why that's part of the reason why the pound has weakened. We have the European Central Bank meeting as well in the same day on Thursday. So three major central banks on Thursday, one on Wednesday, which is the Federal Reserve. Lots of the central bank meetings to look forward to. And so it should be a very, very important week for the markets, which means, therefore, that this week's price action is probably going to be not so significant and driven mainly by events surrounding COVID.
Mainly by
headline-driven markets,
vaccine headlines.
Exactly.
So, it would be, quite choppy, I imagine.
Absolutely. So that's the situation in terms of the macro events. But going back to the charts, the one thing the reason I highlighted, I brought this chart on the screen for you, is the chart of the Nasdaq 100, and so far it's looking strong. Support held where it should have. We bounced. We're not at all-time highs, but I'm doubtful as to whether we will get a new all-time high, because if the Fed is going to increase the pace of tapering, that is going to put upward pressure on bond yields again. Yields have come down in the last few days because of the COVID concerns. Concerns over COVID.
They tested the previous support, the one around 138, and bounced healthily from there.
Yeah.
We're yet to see how do we close today, but
Yeah.
for now, looking at the dollar, which is holding steady,
Sure.
it feels like the bond market it's actually ticking up as we speak.
Yeah.
And it seems like for now the bullish trend in yields is intact.
Yeah.
The key support area around 138 held, and the dollar keeps being
Pushed
bid.
higher. Yeah.
It stabilized around the 96 area.
Yeah.
We haven't seen dramatic moves in recent days, but I feel like this trend could persist for a while, at least until the Fed meeting comes, meaning that dollar strength could continue until the Fed meeting comes.
Yeah. So the dollar is obviously being supported by a stronger or a more hawkish Federal Reserve relative to all the other major central banks. Yeah.
Yeah,
And that's part of the reason I think that perhaps growth stocks in the technology sector might start to underperform the wider markets. Remember, if you look at
right.
let me just bring you another chart up. Just give me 1 second. Is this one?
It's actually the dollar is actually rallying heavily in recent minutes.
All right.
Uh, I'll
Let's have a
be
look at the dollar then. Something came out probably, did it?
Yeah, it's rising against the yen, against gold.
All right.
So
Yeah, you can see the hourly chart here. The dollar is picking up. Let me just see what's moving it. And I can tell you that I can't see any
yeah, the
major
headline
headlines.
is that Pfizer and
Oh, yes.
BioNTech say that free vaccine doses neutralize the Omicron variant, and
Yes, that's according to
two-dose
CNBC.
vaccine
Yeah.
may still prevent the
Yeah.
severe disease. So risk on.
Yeah. As you can see, the headlines are coming up here. Anyway, let's. So yeah, that's risk on again. The Japanese yen, a safe haven currency, is falling.
Yeah,
I'd imagine indices are rising now.
yeah.
Having been, yeah, look, the FTSE's turned positive. Indeed, this is the hourly chart. You can see that after a weaker start to the day, it's kind of turning positive now. So yeah, clearly that's positive news. And
I
upwards and
don't
onwards
think
we
the
go.
market realizes that that actually opens the way for the Fed to
Yeah,
keep on course and taper at a faster rate
yeah.
in a week's time.
Exactly. So that
So,
brings our focus back to the Nasdaq 100, because
yeah,
I was showing you this chart of comparison. Look, this is the comparison of the major indices. I've hidden some of them. Let me just do this. Yeah. So this is year-to-date performance of the major indices.
yeah,
You can see the been leading the gains over the last year. In fact, if you zoom out a little bit, even if you go 5 years to date, the Nasdaq 100 is miles ahead of everyone else. Yeah,
yeah,
and it's all to do with the fact that the central banks have expanded their balance sheets, which have weighed on bond yields and supporting technology stocks that kind of growth stocks is the word I'm looking for. And there's
yeah,
lots of growth stocks in the technology sector, which is why the Nasdaq 100 has been doing this, and obviously working from home and those kind of stocks, the likes of Netflix and so on, they have been doing really well, which is why the Nasdaq is has rallied significantly since the markets bottomed out in the middle of March of last year. But now that we are seeing the Fed turning more hawkish and starting to reduce asset purchases and potentially hike interest rates, this could weigh on the Nasdaq 100 because the dividend yields in the technology sector are comparatively low relative to, for example, value stocks. Stocks that are found in the FTSE 100 or in the Dow Jones, for example. So I reckon that the upside potential for the Nasdaq is going to be limited going forward in the months ahead. So therefore, if you're looking to potentially short one of these indices, I would strongly favor the Nasdaq, but after some confirmation, obviously. Not forgetting our risk management, etc., etc. Whereas if you are looking to ride the long-term bullish trend, then I would favor looking at indices that have stocks that pay higher dividend yields, pay higher dividends. So things like the FTSE 100 is where I think we will see more outperformance, and also mainland European indices. Because the European Central Bank is likely to maintain its current policy stance for much longer than the Fed is. So that should help to keep the downside risks limited. So the likes of the DAX, the IBEX, Euro stocks, all of these indices, I think they're going to come back strongly. Especially the IBEX. IBEX has been the weakest of the major currencies. If you look at the 5-year performance, is down
indices.
Indices. Over the last 5 years, been down by 6%. Year to date, the IBEX is only up 5%. So it's one of the underperforming indices. But I reckon that if concerns over new variant of COVID do not materialize, meaning that if the world economy continues to reopen and travel and tourism resumes and gets stronger, then the IBEX is possibly one of the markets that could benefit from that, because Spain is a beautiful country, has lots of beaches, and people love going on holiday to Spain, which should support their economy next year, because a lot of people have delayed their holiday plans over the last 2 years because of lockdowns and so on. But I reckon that if with the world getting vaccinated, and hopefully we won't see any more significant lockdowns, then we should see stronger Eurozone economy that should help to support travel and tourism stocks, and therefore the IBEX is one of those indices that could potentially start to perform a lot better than it has done. So that's one index to keep an eye on, and maybe it has already bottomed out here.
So I wanted to go back to oil,
sure,
if you don't mind, because after these headlines, it basically returned
positive,
back up towards the top of the daily range, and we're seeing how quickly indeed the sentiment changes just by a single headline. And I wouldn't be surprised if the pound move gets reversed as well, as the UK doesn't actually get into plan B. How does that sound? Maybe.
I mean, the pound has bounced from the lows, finding support from the 38.2% Fibonacci retrace. Maybe that's a coincidence, but it's uncanny how technicals usually time themselves with the fundamentals. And very nice hammer-looking candle on the cable. But because the dollar is strong against other currencies, if you're looking to ride the strength or the potential strength of the pound, I would favor looking at something like the pound against the Japanese yen. For this currency pair, is testing key support here.
Yeah.
Around this area, which has held over the last several attempts to break lower. The Bank of Japan is clearly a lot more dovish than most major central banks, and that's not going to change anytime soon. So if we see a reversal stick like we are today, this hammer candle that's being created at the time of this webinar, if it closes around or higher than current levels, then that would potentially point to a bottom, or at least a short-term bottom, that could then lift us to towards 152.50, which is the previous support and resistance level, and the 200-day moving average converges there as well, but potentially a lot higher over time. Another pound cross I'm looking at is the pound Swiss. Bearing in mind that
That's an interesting one.
bearing in mind that both the SNB and the Bank of England are meeting next week. At the moment, it's still kind of trending lower, but look where we are on the weekly chart. So previously, I was expecting this trend line to hold. We broke down from this bull flag pattern, if you like. So nonetheless, I think that the longer term macro outlook remains positive. So this level is now resistance, and we've already retested this. But in terms of support, the area around 121.50 is really significant, because if you look at the past price action, previously it was finding significant resistance around this level before breaking out. Now we are retesting that zone, and so far in the week we are positive. Additionally, if you look at the Fibonacci's from the low to the high, we are testing the 50% retracement of the entire up move.
Okay.
So these two kind of converge, but it's more the base of the breakout that I'm more interested in, and also the macro backdrop with the Bank of England getting ready to hike interest rates, whereas the SNB, the Swiss National Bank, is nowhere near ready to do that, to tighten its belts yet.
If I had to make a bet, I would say that the S&B is never going to tighten.
That's true.
But
so I think
we already said on this webinar, never say never.
Yeah, so. I mean, the one thing that could weaken the Swiss franc is if the markets kind of rally, stock markets and other risk assets, reducing the safe haven appeal of the Swiss franc. So the SNB doesn't have to do anything for its currency to weaken. But crucially, we have got a potential reversal stick here in the form of a bullish engulfing candle a couple of days ago. Yesterday there was a bit of a pause in the rally, and today we broke lower on those lockdown headlines in the UK. But if we go back above this red line, which is the low from the previous day, then that would indicate that the sellers who sold below the low of yesterday's candle, those guys are trapped, and that we could then squeeze them higher. So a move above 122.33-ish would be positive in my view. The black line here at 122.80-ish is going to be important. I think we'll need to break that for confirmation, but the early indication for a potential reversal would come in if we go above 122.33 today.
So let me just jump in here with some curious facts that this SNB, the Swiss National Bank, is actually one of, they call it one of the largest hedge funds in the world, because
right, that's really interesting.
By printing new money, the Swiss National Bank actually buys stocks globally, mainly in the US. It's one of the biggest shareholders of Apple.
I didn't know that. Really, they own Apple shares.
Yes, they own a lot of tech stocks, perhaps even Tesla, but I'm not so sure about that. So yeah, the risk sentiment here is never to be underestimated. Just because when markets turn, the S&P could start unloading on some of its stock market positions and repatriating the profits at home. So
Right.
that's probably what has been happening over the past, roughly, well, it's
Since,
actually 6 months or even
yeah.
more. Uh,
So is
eight,
that
eight, eight months.
why the Swiss franc is gaining strength because of
I'm
the
just
repatriation?
saying that it could be one of the factors behind the Swiss franc strength,
Yeah.
repatriation of flows
Yeah.
after insanely um, rewarding bet on the U.S. stock
Yeah.
market on part of the S&P.
Yeah, keep an eye on the Euro Swiss because obviously the European Central Bank is still quite dovish and the euro is coming under pressure across the board. But as the Swiss franc appreciates in value against the euro, the risks of another ECB S&B intervention are increasing progressively. So we could see a comeback in despair if the S&B starts to intervene in the markets. In any case, if you go back above 104.92, this black line here, that would be short-term bullish. This is not really my favorite pair because I don't really like the long euro ideas. So I would much rather trade the potential weakness of the franc against the pound or against the dollar. Speaking of
Right.
which, the dollar Swiss weekly chart is poised for a potential breakout as the policy divergence between the S&B and the Federal Reserve grows. So next week we have both the S&B and Federal Reserve meeting. If the Fed does start to quicken the pace of taper and indicate that rates will rise earlier next in the first half of next year, which is what the market is expecting, then we could see renewed strength come in the dollar, which could lift this currency pair out of this consolidation, leading to a significant or potentially significant rally. On the daily time frame, support has held where it should have around the 200-day average and the base of this breakout. I thought it will do something like this. So far, it's kind of doing that, still in the progress. It's work in the progress. I reckon it's gonna go further higher from here. A couple of days ago we had this large candle suggesting that the buyers have stepped in here, which has lifted rates above the recent consolidation, and the high of which is around here. This level is now going to be our key support. If we come down to retest this level, I would imagine there will be some buying interest in this currency pair. But also keep an eye on the previous day's low. Just color that in black. Notice how we went below, and so far there was no desire by the market to hold below yesterday's low, which is a early sign to say that the sellers have got trapped who sold on the breakdown below that level, meaning that if that's the case, then price is likely to rip higher and go to levels where their stops are going to be resting the seller's stops, which an obvious place would be above yesterday's high. So the first target would be this level, 92.75. Then from there onwards, if there's acceptance above that level, we could see if there's acceptance above that level, we could then see a quick rally to take us above the more significant highs that were created in September and in November around 93.70-ish.
All right,
So
shall we have a look at precious metals then?
yeah, so looking at the FX, I would imagine precious metals are weaker today. Well, moderately stronger they are, but
Well,
probably come off the highs, have they?
considering where we were an hour
Yeah.
ago, gold
Where
has
were we? Yeah,
definitely
yeah. There you go.
pulled back and reversed that earlier break above 90, and it's now consolidating just above 86.50.
Yeah.
The 200-day moving average has been touched once more, and the
It's offering
magic number.
resistance. Yeah.
And we're seeing a pullback after that.
Yeah.
The vaccine news are certainly not positive for gold because, as I mentioned, the Fed seems now to be open, like they should basically deliver on their promise and accelerate tapering.
Yeah. So gold is held between a hard place and a rock. Fundamentally, it's coming under pressure because of the strength of the dollar, because of expectations of higher yields in the US as the Fed starts to quicken its taper. While on the other hand, the downside has been limited because of concerns about inflation, runaway inflation. A lot of people still see gold as a hedge against rising prices. They've been buying the dips in gold to protect their wealth from being eroded by the impact of inflation. And as fiat currencies are losing value across the globe. If you look at emerging markets, for example, the Turkish lira being one of those, it has been, falling to record lows repeatedly. And even the euro has weakened, and Japanese yen, another one. All of these currencies, because of central banks not doing or doing what they should be doing, which in the case of Japan, but in the case of the Turkish lira, doing the opposite. The point I'm making is that inflation has been rising globally, and gold is one of those assets that traditionally has benefited from rising price pressures, and that's the only thing I reckon is which is or a number a handful of things that's still holding up gold. For if otherwise, the Fed was tapering, surely gold would have broken down more significantly by now. But it's inflation and concerns about inflation that is still keeping the downside
Well, yeah,
risk limited.
basically the switch in the language from the Fed has really hurt gold, and it was just about to go test 1900 level again when we had those first signs that the Fed is considering to increase the pace of tapering.
Yeah.
And after Powell said it, things didn't get any better. So
Yeah.
there you go. That's
So
the
would
short
you say
recap.
then would you say that gold has priced in a hawkish Fed
I
because it
wouldn't
has
say
fallen?
so, not
Yeah.
yet. I imagine that we have another week at least of downside, probably a test below 1760, and possibly lower. Who knows?
Right.
Depends on it's still, if we have this risk sentiment come back and a new market, stock market all-time highs just before the Fed meeting. That could be also something that is hurting gold because
Yeah.
obviously risk gets away from the market. Speaking
Yeah.
of which, looking at the cryptocurrency space, Bitcoin hasn't really been very convincing in its
No.
bounce this time
No.
around.
Yeah, if you recall from our previous webinars, we were mentioning the importance of the 60,000 level, and Bitcoin had broken below that level, and we said it needs to get back above that to start printing new highs again. And so far, well,
Never
it failed,
did.
didn't it?
Yeah.
And yeah, what do you reckon from here?
Well, I continue to hold the view that we have seen the highs in Bitcoin for this year, and
Yeah.
from here on out, it's likely to accelerate to the downside. If you look at the monthly chart, it looks really, really bad
Yeah.
for Bitcoin.
For this year, we've only got a handful of, well, couple of weeks, few weeks.
Yeah,
So you reckon it's not enough time?
just what I'm
For,
saying is that
yeah.
basically the hammer candle that was formed in November is now confirmed, and we continue to drop lower as we speak, and
Yeah.
I don't really see any easing in the pressures against Bitcoin and recent fundamental developments,
Mm.
particularly around electricity prices worldwide.
Yeah, it's
We,
interesting you
we,
mentioned that.
we did see a headline this morning from Iceland, of all places, which is producing 99% of its electricity from renewable sources.
All right.
And they have actually said that they are not canceling, but they're not going to renew any contracts for electricity for crypto miners. So
Oh,
that country is basically killing crypto mining. And I don't expect this to be the last country that does, because it doesn't make any sense to let crypto miners drive electricity prices higher for the end consumers.
yeah. Let me share with you this. You're speaking about electricity prices and stuff. I came across a chart of electricity prices. Let me just bring this up. Someone shared it on social media, and this was it. German power prices just hit a fresh record high, as you can see, 180 almost euros per megawatt per hour.
Yeah, it's pretty much four
That's
times
gonna,
higher, four
yeah,
times higher than last year. So
yeah, that's gonna raise inflation, isn't it, as well?
it is. It is
Yeah,
one of the biggest factors that is contributing to price rises all over the world.
yeah,
Um, but yeah, crypto mining is not helping, and I just don't see this industry continue to be able to find new homes. Probably eventually, all crypto mining is going to have to move to Russia, and guess how much is Uncle Sam gonna love that?
a lot.
Yeah.
Um, Ethereum is holding its own relatively better than most other cryptos.
Yeah,
Um,
yeah,
we
it
did.
is. However, yesterday I was looking at the another screenshot on in the Twitter sphere where a guy wanted to send for Ether, and he was asked for 120,000 gas
Oof.
for that transaction. So I
That's a lot. Yeah.
not a very useful network really at this
No.
point in time. They're gonna need to do a lot more work in order to solve these issues. I know that they said that they're going to work on this issue, but it's gonna take some time before it gets resolved. And
Yeah.
until then,
Yeah. It's weakness across the board, isn't it? It's not just Bitcoin. So yeah, be careful out there. If you're into cryptos, they are known for their extreme volatility. And if you go back to Bitcoin, where's it gone? it's fallen quite significantly from its highs. At its worst, it was down about 38%. Right now, it's down 28% from the high, the all-time high.
Yeah.
So
Again and
yeah.
again and again, I cannot comprehend the argument that this is a store of value.
Right, which then raises the question: in light of the weakness in cryptos, in light of the rising inflationary pressures around the world, and all the other risks facing investors, shouldn't gold be shining more brightly right now, or should it be shining more brightly in the near future?
Well, Mr. Market says not for now.
Not for now. Not for now. But if anything is to withstand the strength of the dollar, I reckon it's going to be gold, because of the things that are happening around us: inflation going up, cryptos plunging. So we may see some inflows from crypto markets into gold, possibly. So far, we haven't seen that, but let's see if that trend changes. For gold to kind of make a significant comeback, it does really need to close on a daily basis above the 200-day moving average. Look how it has struggled to close above the 200-day after breaking below it. It's had several attempts to break above it, failed each single time. So I reckon a daily close above the 200-day moving average would be a very positive sign. For that will also take us back above the broken trend line, which
you know me and gold.
Yeah.
I think that we've seen recent highs in gold, and we're gonna drop down to test the 1680 level eventually.
Yeah, I mean, right now the risks appear to be to the downside. I wouldn't disagree with you too much there. So that's why I'm kind of waiting for a significant bullish technical sign before potentially stepping in on the long side again. But for now, it doesn't look very strong.
All right. So do you guys have any questions? We are very much open to discuss anything that you feel we have missed in the current market environment. And if you have any ideas that you would like to discuss, or questions about the market, we are ready to answer those.
Yeah.
Apparently not really, which is good. I take it that then we have covered most of what's currently important.
Yeah.
And with that, we're going to
we're gonna end the webinar. Before we do, just reminder that to join our regular webinars, go to our website at thinkmarkets.com, go to market analysis, and click on live webinars. Here you will see a list of our upcoming webinars. And then just register with one of them by clicking on the register button. So hopefully we shall see you next Tuesday is the next one. The regular live market analysis webinars. So for those of you who have watched this on YouTube or elsewhere, please like and share, as that will encourage us to produce more content like this. Thank you so much, guys. Take care.
Thank you. Bye-bye.